A global economic slowdown has led to economists factoring lower growth for India. Numerous banks, agencies, and international organizations recently lowered their estimates for India's GDP in fiscal year 23. And the recent downgrading of India's growth projections by global rating agencies has been making headlines every single day. Now, the much-awaited Q2 GDP numbers are out. And in this episode of Third Umpire, we will discuss the intricate details of the GDP data and see if the Indian economy is still resilient. While we talk about this, we will also cover the recent amendments made by the Insurance Regulatory Authority, which the industry experts have hailed as a positive development. We will also talk about the implications it will have on the insurance sector as a whole. In our conclusion, we will talk about the merger of Vistara and Air India, which is likely to lead a duopoly in Indian skies. Let's begin. You're watching Informed Investor, the Third Umpire, initiated by Research and Ranking. The expansion in real GDP for Q2 moderated to 6.3% from 13.5% in Q1, led by a normalizing base. Now, for Q2, economists had predicted an economic growth rate somewhere between 6.2% to 7.2%. Now, the print was in line with the MPC's forecast of 6.3% for the quarter, but the base effect continued to play a big role in the GDP growth numbers. Now, this was largely on account of the massive contraction in the first half of fiscal year 21 because of the nationwide lockdown that began on March 25th, 2020. Now, the slow growth in Q2 from Q1 is attributed largely due to the normalization of the base effect. Before we move on to the finer details of the GDP data, let's get back to basics and understand a little more about GDP and how India calculates it. To assess India's productivity, the GDP is calculated using two methods. One is the factor cost method across 8 industries, which we will cover in the following sections. And two is the expenditure method. Now, under the expenditure view, there are 4 main components that are used to calculate GDP. Now, these components are the main engines that drive economic growth in a country. They are private consumption expenditure, which is denoted as C. This is the amount of spending on the consumption of goods and services by consumers like you and I. Now, the restaurant we dined in, the car we bought, medical expenses, or any indicator that throws light on consumption and demand will fall under this category. Private consumption expenditure currently accounts for the largest, that is 58.4% of our GDP. Gross fixed capital formation, denoted as I, is the total amount of spending on the investments in the capital assets by the private sector and the government. Now, this constitutes around 30% to our GDP. Now, G, that is government consumption expenditure, is the total spending by the government on the infrastructure to boost the country's economy. NX is equal to net exports, which are exports minus imports. Now, since India typically imports more than it exports, this is the smallest engine of GDP growth, and often it is negative. Now, when you add all of these factors, it gives you the total GDP. Now, in other terms, GDP is defined as the total market value of all expenditures made on consumption, investment, government, and net exports in 1 year. Now, the details of real GDP indicate that private consumption grew about 9.7% year over year in Q2, and real investments, that is gross fixed capital formation, grew 10.4% year over year. And on the contrary, government consumption contracted by 4.4% in Q2. Let's understand why. Most of the gain in consumption has come from the urban demand, which indicators such as GST collections, retail credit, passenger vehicle sales, posting strong growth in this period. Now, however, rural demand is still yet to see a recovery. Now, so we see a divergence in the growth of urban and rural consumption indicators, with urban consumption doing better than rural. Now, this is due to elevated inflation weighing on rural consumption demand. Now, government expenditure has taken a backseat. From April to June, government expenditure had expanded by about 1.3%, but it contracted by 4.4% during July to September. Now, due to COVID-related expenses, the government significantly raised its spending over most of 2020 and 2021. So it is only logical that it is now attempting to reduce spending. Now, GDP has also been hindered by a substantial decline in net exports in Q2 compared to a year ago level. Now, the decrease in net exports is anticipated to continue and to be of a concern due to worries about a slowdown in global growth and a weaker currency. Under the factor cost method, the agriculture and services sector, such as the combined sector of trade, hotel, transport and communications, and financial, real estate and professional services, saw year-over-year growth accelerations. Industrial output, however, contracted by 0.8% in Q2 on a year-over-year basis compared with the growth of 7% a year ago. Now, this was mainly because of the poor performance by the manufacturing sector. Now, this also shows how increasing interest rates and rising raw material costs are beginning to hamper the manufacturing growth. Nevertheless, due to the festive season and the decline in commodity prices, we can anticipate this sector to do well in the coming quarters. When we look at the Q2 GDP data, there are some positive details, but there are also some worrying details. Now, although growth is resilient, downside risks are increasing. Now, on the demand side, the year-over-year GDP growth in Q2 was boosted by the performance of private final consumption expenditure and gross fixed capital formation, whereas government final consumption expenditure shrank and net exports had a greater negative impact. On the production side, services activity was the major driver of growth, while the manufacturing contracted. Now, with favorable base effects disappearing, growth is expected to normalize over the coming quarters. Now, headwinds to the Indian economy are steadily increasing due to the lag effect of monetary policy tightening and the looming global slowdown affecting exports and domestic demand. Now, because of the macroeconomic environment we are facing right now, there will be revisions from both international and domestic agencies. But even if the majority of them have lowered their growth forecast for fiscal year 23 by a few percentage points, India is still expected to grow between 6 to 7%. Now, in the years to come, India will have the fastest growth rate in the world. Now, this must be our main takeaway as long-term investors. India's GDP may have performed well to move up to the 5th rank globally, but the nation still has a long way to go in terms of insurance penetration. Now, the liberalization of India's insurance industry will enter its 22nd year in 2022. India, however, continues to trail below the global norm in terms of insurance penetration even after more than 20 years. The Economic Survey of Fiscal Year 21 states that as of 2020, India's insurance penetration was 4.2%. Now, these may be the result of a variety of factors, including low levels of education, regulatory difficulties, and barriers to innovation. Now, for insurance companies, this under-penetration presents a significant opportunity. The Insurance Regulatory and Development Authority of India, which monitors the entire insurance sector in India, recently announced reforms that is expected to help strengthen the ease of doing business in the insurance sector and aid in making the sector more investment friendly. The organization's mission is Insurance for All by 2047, and its goal is to increase the penetration of insurance in the country. Now, the insurance regulatory has approved several changes in capital, ownership, and solvencies of insurance companies. Firstly, it has made investments through a special purpose vehicle optional and permitted private companies to make direct investments in insurance companies. Now, investors can take a 25% stake in insurance companies without being designated as promoters. Now, as opposed to the previous limit of 3 insurers, corporate agents, including banks and NBFCs, can now partner with up to 9 different life, general, and health insurance providers. Now, for insurance marketing firms, 6 tie-ups are permitted as compared to 2 earlier. Now, the regulator has also lowered solvency requirements and relaxed the rules for raising money through subordinate debt or preference shares. Now, most industry analysts have hailed these amendments, calling it positive for the overall insurance sector. Let's discuss why. Perhaps the only financial market in India with a high degree of concentration is the life insurance industry. Now, nearly 90% of the industry is controlled by the top 5 listed companies, including the behemoth Life Insurance Corporation of India. Now, big life insurance companies have so far maintained comfortable solvency ratios and capital positions. However, there are plenty of examples of small businesses that are unable to expand because of capital constraints. Now, due to this, you've got the market that is unbalanced and full of small insurers that have the creativity to launch specialized products and gain market shares but lack the resources to do it. Now, these amendments are to work towards ensuring easier access to capital, which can then be channeled into technology, product innovation, and increasing awareness about insurance. And less capital constraints will also encourage long-term sustainable investments. Now, other reforms is also aimed at improving insurance penetration in the country by allowing more tie-ups for intermediaries and corporate agents. Now, the increase in the number of tie-ups will also enable policyholders to have a more wider choice. Now, reforms targeted at ease of doing business will simplify the process of setting up an insurance company and encourage new players. The Insurance Regulatory and Development Authority of India's recent forward-looking moves are expected to propel ease of doing business and spike the sector growth. Now, most industry analysts have hailed these amendments, calling it a positive development which will help attract long-term capital to the sector. Now, they also anticipate that India, one of the world's insurance markets with the greatest rate of growth, will move up from 10th spot to 6th spot in terms of total premium volumes by 2030. Allowing PE players to engage directly in insurance companies is also the most important change in this area, since it will open up the door for new investments, particularly in insurtech and new age insure companies. Now, due to improving demand following the pandemic, a strong India growth story, and regulatory pressure for more insurance penetrations, PE's enthusiasm for the insurance sector has been growing. Now, this action will greatly simplify investing, which is advantageous for the industry as a whole. Overall, the insurance industry in India is undergoing many regulatory changes, which bodes well for the overall sector. Less than a year has passed since Air India was given back to its original owners, the Tata Group. Now, it has been quite the journey for the flag carrier of India. In 1932, Tata Group founded Air India, and in the 1950s, the government took control of it, and Tata finally acquired it back last year. Now, under the new management, the Air India is getting a major makeover. After merging low-cost carriers AirAsia with Air India's low-cost subsidiary Air India Express, it is also moving towards merging its other two full-service airlines, Vistara and Air India. On Tuesday of this week, the Tata Group announced that Vistara and Air India would merge by March 2024, and Singapore Airlines, which now owns about 49% of Vistara, will receive 25.1% of the combined Air India. Now, the merging of the Tata Group airlines will result in the combined entity Air India becoming India's second largest carrier. This will be the largest merger in India's aviation industry. Now, Indigo is India's largest airline, accounting for more than half of the domestic market. The merged carrier could potentially challenge market leader Indigo. Now, with the merger of Vistara and Air India, the Indian domestic airspace is becoming much smaller. With this integration, Air India will be the only Indian airline group to operate both full-service and low-cost passenger services. Now, this would also reinforce its position as India's largest international carrier and second largest domestic carrier. Now, Air India has the advantage over Indigo in the sense that it can poke into the latter's market share with its aggressive pricing through its low-cost Air India. However, in the fight of elephants, the smaller airlines will have a tough time surviving, leaving the skies open to the two players to battle it out. Now, Air India also stands to benefit from Vistara's operational capabilities, a huge customer base, and also a strong focus on customer services. Now, Vistara and AirAsia India are yet to turn profitable. Now, the merger is expected to give economies of scale as well as better cost management. Having said that, all these positives will also depend on Tata's ability to pull off these complicated mergers and integrate their strengths with partners. The aviation industry is headed towards a duopolistic structure, with Air India and Indigo making up a dominant 80% of the market once the merger is completed. Now, the deal represents a significant consolidation in India's rapidly expanding aviation industry. The deal will make Air India the country's largest international carrier and second largest domestic carrier. Now, the merged carrier could potentially challenge market leader Indigo. Now, according to industry analysts, both of these companies will benefit from the structural command, which will offer them stronger pricing power. Now, this is crucial because the sector is currently experiencing challenges due to an increase in the price of aviation turbine fuel. Having said that, do know that this is a commentary just on the merger, and this is not a stock recommendation, as that entails details of valuation exercise. This was our attempt to bring you the insights that really matter. This is me, Merlin Susanna, signing off. Take care and stay invested.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.